Okay, so now we know that we use the allowance method to estimate allowance for doubtful accounts or our bad debts at the end of each period. And under that allowance method, there's 3 approaches that we will look at to actually estimate the uncollectible amount. The first one is called the percentage of sales method. Then we've got the aging of accounts receivable method, and finally the percentage of accounts receivable method. So we're going to start by looking at the percentage of sales method. So under this method, we compute or calculate bad debt expense as a percentage of net credit sales. And it's important to note here that we use net credit sales. So that means only those sales that were booked through AR. So not cash sales, just sales that were done on account. And the reason for this is because if we've already had a cash sale, we've collected that cash, so there's no bad debt expense related to that. So we just use net credit sales or credit revenue. And if the question just tells you the sales amount, then you just use that. But if it tells you overall sales and the credit sales, you would use credit sales. Now, this percentage of sales method is also at times called the income statement approach. And the reason for this is because we're basing it on sales, our credit sales, which is an income statement account. As well, we're calculating the bad debt expense under this method. And this is also an income statement account. So for both of these reasons, it's called the income statement approach. When we use percentage of sales method, we're going to ignore the current balance that sits in the allowance for doubtful accounts. So if there's a balance left there from the previous month or the previous year, we ignore that for now, and we're booking an additional amount of bad debt expense on top of that. So to calculate the amount that we book, we're calculating our bad debt expense, and we take the net credit sales times the estimated uncollectible percentage. And this bad debt expense amount, this is the amount used in the journal entry. So we're actually calculating the bad debt expense for that period, and we will record that in the journal entry. Okay, so here is an example. Based on prior experience, the company thinks that the bad debt expense is 2% of net credit sales, and the credit sales for the year were $500,000. So we calculate in the percentage of sales method, we're calculating bad debt expense. And as I said here, we calculate it as net credit sales times that uncollected percentage. So here our credit sales were $500,000, and we expect to have bad debt of 2% of that. So if we multiply that out, our bad debt expense is expected to be $10,000. So the adjusting entry that we record here to record bad debt expense and update that allowance, we will debit bad debt expense. So we're increasing that expense, and we're using the $10,000 that we calculated. And our credit goes to the allowance for doubtful accounts. So since this is just an estimate, we're using this contra account. So remember, this is the contra asset. So we don't right now decrease AR because this is just an estimate. We don't know that specific customer. Okay, so by doing this entry, the effect that we have is a decrease to net income. And that's because we increased an expense by debiting bad debt expense. More expenses means a lower net income. And we're also decreasing net accounts receivable. And again, because we increased that contra asset. And a contra asset has the opposite normal balance, this credit. So it's bringing down the net AR amount, which has a normal debit balance. So in this percentage of sales method, as you can see, we are actually calculating bad debt expense. So this value that we calculate, that's what's used in the journal entry. But that's only done in this method. You'll see that in our future methods, we do something different. Okay, so if we continue on with this example, the accounts receivable balance that we had before the entry was $100,000. And again, before this adjustment, the allowance for doubtful accounts had a balance of $1,000. So what is the amount of net accounts receivable after the adjustment? Well, if we take a look at T accounts here, we can set these up for our AR account. And I'm just going to write AFTA for short here. So we can put in these opening balances. We have 100,000, and then our AFTA was 1,000, which we know is the credit. So at that point, we had a net amount of 99,000. But we need to now book or post this entry here. So we had another $10,000 to AFTA, which gets our balance to 11,000. So after this, our net AR that you would see on the balance sheet is at $89,000. And we know we would also have our bad debt expense as well. This is not part of net AR, but just to make sure we show that, it would have that $10,000 that was booked as well. So on the balance sheet, you typically actually show the full detail. So you would show accounts receivable of 100,000. We would say less the AFTA gets us to, or was at 11,000 after the adjustment. And finally we get our AR net, which is the 89,000. Okay, so that's the percentage of sales method. We're calculating bad debts and recording that full amount in the entry. In the next video, we will take a look at the aging of accounts receivable method.